All right, another week, and this one might be a big one. I'm calling it Wake Up O'Clock in the Bond Market, and we're going to see why. A couple of quick things before we get going. I see that we are up to 155 subscribers. For any of the new folks, please remember to use the playlist. It's called the Income Investing Roadmap that organizes the show in order so you don't have to pick up stuff in the middle. Having said that, my disclaimers: I am not a wealth management advisor. I'm not pitching any product. I'm not endorsing politics. And whether you buy or sell or do nothing, my goal is to share what I learned, and this is education. A couple of things in my opinion. First, we'll review where we are, how we got to where we are. And then I call this Wake Up O'Clock because there are some very clear signs that should call the attention of a bond investor in today's market. And finally, strategy between now and the next 6 weeks. Quick reminder about where we are. We are at absolute all-time 20-year highs on short-term interest rates, and it looks like rates may go up even higher because of the quote resilient American economy. If the target is to decrease inflation to 2%, then the Fed should continue increasing rates. And so as long as that is the stated goal, we are in for an even higher short-term interest rate. Having said that, why do I think it is wake up o'clock in the bond market? Let me tell you more. You may remember we've been talking about this potential conflict between the two parties and the potential government shutdown. It looks like there is a stopgap that might come. And if the stopgap does come, it doesn't really solve the problem. It merely gives it 60 days more lifeline and possibly a harder fight. So that is not resolved. And hey, in the style of Steve Jobs, there is one more thing you may want to look at. Saudis, who are one of the top customers of US treasuries, have vastly cut down their purchases. Guess what they are buying instead of treasuries? They did buy some gold, but actually they are investing in venture capital in the US. So they're going to riskier assets and not holding US treasuries, which is something that will rattle the treasury market in a very different way. And I'll tell you more in a second. What about China? China has also dramatically decreased its treasury holdings. In part, that is so it can focus on stimulating its own economy. You've read in the news that there are some slowdowns in the Chinese economy. They're cutting rates and so on. Japan has come up with a new formula. They said, hey, we're going to count our economics differently, which makes their own treasuries far more attractive to local investors. And therefore, Japan and its people are going to hold local treasuries and not as much US dollar denominated treasuries. The combined effort of all of this means demand for US treasuries is now much, much lower. And right as it is happening, the Fed is shrinking the balance sheet. What does that mean? There is less money in supply. If there is less money in supply, if demand is less, and the Fed says, hey, by the way, would you like to borrow from me? What do you think is going to happen? Let me state that again. There is less money in the market, so the money that is there has to chase the best opportunity. International governments are not holding US treasuries. It pays a whole lot more to buy short-term treasuries than long-term treasuries, which means the average person would gravitate towards the short-term market. If everybody goes towards the short term, the long term becomes very unattractive, and therefore the Fed has to pay a higher and higher yield in the long term to get people to buy it. What happens as that keeps going up? This is kind of bananas, and I don't see how it is going to happen again. In the 80s crisis, we had long-term 10-year interest rates of 15%. And I don't think those days are going to come again. And if it does, we are in very deep trouble. Having said that, the most stable time to have bought a treasury would have been around 5%. When the 10-year reached 5%, if you bought it for 10 years, you kind of sat on it and you made out really, really well because generally the 10-year treasury rate fell. And so the magic number that people talk about, and we are at 4.25, if indeed the 10-year treasury reaches roughly 5%, remember it's state tax free, so it's more like 5.5% for the folks in India, I mean, in Illinois, I mean. If the 10-year reaches 5%, it becomes an extremely attractive asset to buy. Just keep that in mind. So my conclusion is whether there is an October shutdown or a December shutdown, I don't know. But all I know is that the demand for treasuries is becoming lower by the day. Supply is going to become higher by the day because the government has indicated they will be raising $1 trillion in the next quarter. So there is a whole lot of need and a whole lot less demand, and that means prices will increase on the long-term side. So what would a yield nerd do in the next 6 weeks, that is? My thesis in the next 6 weeks is that inflation is still going to be high, and there are two areas where inflation is going to be stickier, and I am a broken record in that area. I am high on agriculture, food-related products, and energy. And here is the S&P, that is the blue line. It is being compared against the red line, which is the energy sector, and the yellow line, which is the agricultural product sector. As you can see, when things got harder for the stock market in general, the S&P in general, oil and agriculture went the other way. And part of the rationale being the companies that posted lower earnings were all in the general category. Oil companies have tremendous cash flow, very good value stock, and the same for certain agricultural companies. My thesis, I'm going to keep going on my general direction of food and energy, value investments for equity, and for all else, I'm just going to stick with short-term treasuries. When I apply a filter specific to which food companies are really performing well, I come up with Archer Daniels Midland, Bunge, and Ingredient. You should do your own homework and decide. These are companies with double-digit cash flows, low debt, high profitability, and that is why I picked them, but you do your own math. So having said that, then here are my trades for the last 7 days. I picked up a whole bunch of energy companies, and I also picked up Chesapeake Energy and a couple of food companies. We'll talk about what they are. Ingalls Markets, a very high cash flow company with very low debt. And so my guess is that if the market crashes, these should generally hold. And as you can tell, I have several treasuries maturing during the week. And every time they mature, I turn around and buy very short term. Some of them, maturing in October, others maturing in February, but kind of very 3-month, 5-month type treasuries. I did get out of Cisco. I don't really stay in tech stock. And my whole thesis is short term, short term, short term, and wait until the 10-year reaches 5%, at which point I will increase duration. But for now, it is food, energy, treasuries. My 13-week scorecard is still pretty healthy. While the market had serious rattles, my portfolio barely blipped, and I'm over 3 months at a return of 3.28%. The market had a 5% return, but here is the big difference. In my portfolio, I make 6% yield. The average dividend of the stock market, if you owned it, is something of the order of 2%. So I get 3 times more income, and I capture most of the upside. When the market goes up by 5%, I still go up by 3.28%, and I make 3 times the income. That is the power of a fixed income portfolio. Having said that, I did make a note. The reason you see this giant up and down is because I went to cash, because I didn't know what was happening for the debt ceiling deal. Having said all of that, shutdowns do not rock the equity market, but I am going to keep dry powder handy, either around October or December, depending on whether the interim resolution goes through. Outside of equities, I am literally going to sit around and wait for the 10-year to reach 5%. And at that point, I will be increasing duration. Thank you for your questions, comments, yieldnerd@gmail.com.